How do credit cards actually work? Ever wondered how your credit card gives you free flights, cashback, fraud protection, and lets you buy stuff you can't afford until next month, without the bank going broke? Spoiler, the bank is not doing this out of kindness. They're doing very well, actually. Today, we're breaking down how credit cards actually work, and how banks really make their money. Chapter 1. What a credit card actually is. At its core, a credit card is just a short-term loan. When you swipe your card, the bank pays the store for you. Then later, you pay the bank back. That's it. That's everything. But here's where it gets interesting. If you pay your full balance by the due date, you pay zero interest. If you don't, welcome to Interest City. And Interest City is expensive. Chapter 2. The three main players. Every credit card transaction involves three main parties. 1. You, the cardholder. 2. The bank, the issuer, like Chase, Barclays, Amex, etc. 3. The merchant, the store you're buying from. There's also the payment network, Visa, MasterCard, Amex, which helps process everything behind the scenes. So when you tap your card for a £50 dinner, the bank pays the restaurant. The restaurant gets slightly less than £50. The bank hopes you don't pay them back in full. More on that in a second. Chapter 3. How banks actually make money. Banks make money from credit cards in three main ways. 1. Interest. This is the big one. If you carry a balance, you're charged interest, often 18% to 30% APR. Let's say you owe £1,000 and your APR is 24%. That's about £240 per year in interest if you carry that balance. Now multiply that by millions of people who carry balances. That's not pocket change. That's yacht money. Important detail: banks don't actually want you to completely default. They want you to carry a balance, responsibly miserable. 2. Interchange fees, swipe fees. This is the sneaky one most people don't know about. Every time you use your credit card, the merchant pays a fee, usually around 1% 3% of the transaction. So if you spend £100, the merchant might receive £97 or £98. The bank and card network split the rest. That's why some small businesses prefer cash, those fees add up. And this is how banks can afford to give you cashback rewards. They're basically sharing a slice of what the merchant paid. It's not magic. It's just redistribution. 3. Annual fees. Some cards charge annual fees, £100, £250, sometimes way more. In exchange, you get travel perks, lounge access, insurance, points, etc. For some people, it's worth it. For others, it's a very expensive metal rectangle. Chapter 4. Why banks love minimum payments. On your statement, you'll see something called the minimum payment. It might be something tiny like £25 on a £1,000 balance. If you only pay the minimum, two things happen. 1. You stay in debt much longer. 2. You pay way more interest. Banks design minimum payments to keep you paying for years. If you paid only the minimum on a large balance, you could end up paying double the original amount. The bank isn't forcing you. But they're not exactly sad if you choose that route. Chapter 5. The grace period. Here's the part most financially responsible people use to their advantage: the grace period. If you pay your full balance every month, you avoid interest entirely. Which means you're basically using the bank's money for free for about 30 to 55 days. And the bank still earns interchange fees from merchants. Possibly annual fees. So even perfect customers still make them money, just less. Chapter 6. Credit scores and why banks care. Banks don't give everyone the same card or limit. They check your credit score to estimate how risky you are. They want people who probably won't default, might carry a balance, spend regularly. In other words, stable, but not too stable. Someone who pays in full every month and never pays interest. Good customer. Someone who maxes out cards and disappears. Not good. Someone who carries moderate debt for years. Very profitable. Chapter 7. Are credit cards good or bad? Credit cards themselves aren't evil. They're tools. Used wisely, they build credit history, offer fraud protection, give rewards, improve cash flow. Used poorly, they charge high interest, encourage overspending, create long-term debt. The bank's business model depends on a percentage of users carrying balances. That's just math. Chapter 8. Closing. So to summarize, when you swipe your card, the merchant pays a fee. The bank pays the merchant. You pay the bank. And if you don't pay in full, you pay extra. Credit cards feel convenient because they are. But convenience is rarely free, it's just delayed. If you found this helpful, like and subscribe. This has been a mini Leviathan production. If you enjoyed it, check out our other videos. See you in the next one.